A sole proprietorship is not a separate legal entity. You don't have to have an LLC or any other type of, state level entity to form a sole proprietorship. You can run a sole proprietorship just with your social security number. And in fact, that's how most people do it. I don't recommend that. I usually recommend that taxpayers obtain an EIN and do business under the EIN so that they don't have to give their social security number to vendors. But you can potentially run your sole proprietorship with just your social security number and never request an EIN. Assuming you don't have employees, and just run your business that way. It's not a separate legal entity. A sole proprietorship is an unincorporated business that is owned and controlled by one person. Now, a sole proprietorship can have employees, but by definition, a sole proprietorship is just owned and controlled by one individual. A sole proprietorship is the simplest business type, and it's also the easiest to start. You don't need to file any paperwork. In most municipalities and in most areas, cities, you just would need to obtain a business license. Most cities will require you to obtain a business license, but in some municipalities, it's free. For example, in Las Vegas, in Nevada, if you want to obtain a business license, you just go onto the Nevada business portal and you fill out the paperwork, but it doesn't cost anything if you run your business from your home. So a sole proprietorship and a partnership that's home-based doesn't cost anything to run, literally, in Las Vegas. I know that's not the case in every city, obviously, but at least in Las Vegas, Nevada, if you want to run a sole proprietorship from your home and it's an unincorporated business, you could do it for free. You could basically start that business for free and not have to pay anything. So a sole proprietorship is the simplest business type. It's also the easiest to start. An estimated 70% of businesses in the United States are sole proprietorships. So the majority of businesses in the U.S. are sole props. They're sole proprietorships that are run by just one person. That's the majority of small businesses. But the majority of the tax revenue that's generated by businesses in the United States is not generated by sole proprietorships. The majority of large businesses are C corporations. C corporations. There's very large partnerships too. I want you to understand that. But the majority of the business revenue that's generated by business entities in the United States is generated by large C corporations like Tesla, like Ford, like Apple. Those are very large C corporations that are publicly traded. So the majority of small businesses in the United States are sole proprietorships, and the majority of large businesses in the United States are C corporations. If a business operated as a sole proprietorship is sold, it must be operated by the new owner as either a different sole proprietorship or a different type of business entity through the sale of assets of the business. You cannot sell a sole proprietorship, technically. You could sell the assets of your business. For example, let's say I have a Schedule C tax preparation business. I'm a tax preparer and I'm filing on a Schedule C. So it's a sole proprietorship. But I want to retire and I want to sell that business. I can sell the assets of my business. I can sell the assets of my sole proprietorship. For example, my computers, my equipment, my filing cabinets, and I can also sell my book of business. So that's an intangible. My client list, I can sell that. And generally when CPA firms and accounting firms, bookkeeping firms, when those get sold, that's the largest part of the sale price is the book of business, the clients basically of the business that are being acquired by another accountant. I could sell all of those assets and that's fine, but I cannot sell like the EIN of my business. And in the case of a tax preparation business, I can't sell my EFIN either. My EFIN, my electronic filing number, for actually submitting tax returns. That can't be transferred to another person. So I can't sell the actual sole proprietorship. I can sell the assets of the business, but that's different. That's a different thing entirely. That's an asset sale. It's not You're not actually selling the sole proprietorship or the entity itself. You're not selling that to someone else. You're selling the assets of your business. A C corporation is not like that. With a C corporation, it can transfer ownership through a stock sale and continue on. For example, if you have a C corporation like Ford or Coke or Tesla, that can be acquired by another C corporation, and that's frequently done where the ownership changes, but you can't do that with a sole proprietorship. Sole proprietorship cannot be transferred. You can sell the assets of the business, but that's a different thing entirely. Partnerships, an unincorporated organization. Remember, this is not a corporation. A corporation cannot be taxed as a partnership, and a partnership cannot be taxed as a corporation. These are two completely different entities. And I thought that this was obvious, but in one of the groups that I belong to, one of the professional tax pro groups that I belong to, another practitioner actually posted this question not too long ago. There was a business that had filed articles of incorporation in the state that the business was operating in. And the practitioner asked, can I elect to have this corporation taxed as a partnership? Nope, you can't do that. A partnership is an unincorporated organization, which means it is not a corporation that has two or more owners. For a partnership, you have to have at least two owners in the mix. Those owners don't necessarily have to be humans. For example, you can have a partnership where one of the owners is a natural person, a human, like you or me, and then the other partner can be a corporation. You can have a partnership that has multiple entity types as owners in the partnership, although most of what you're going to see is partnerships that are owned just by natural persons. But you have to have at least two or more owners to have a partnership at all. So it's an unincorporated organization with two or more owners. It's generally classified as a partnership for federal tax purposes if its members carry on a business and divide its profits. A partnership can be anything from a small business run by a married couple with just two partners to a complex business organization with thousands of general partners and limited partners. So partnerships can be huge. Limited partnerships especially can be huge with thousands upon thousands of partners. Most of what you're going to see in practice is going to be small partnerships. A married couple, a brother and sister or a father and son running a business together. Maybe two or three partners, less than 10 partners. That's most of what you're going to see in practice as an enrolled agent. But partnerships can be enormous with hundreds or even thousands of partners. They're very flexible. That's why they're chosen for investment purposes and also for certain business types. Partnerships are very desirable. A partnership must file an annual information return to report the income, deductions, gains, and losses from its operations, but partnerships themselves do not pay income tax in general. There's only one time where a partnership now will pay income tax, and that's if the partnership is audited under the centralized partnership audit regime, and then tax is assessed at the partnership level. This is generally considered very bad to have tax assessed at the partnership level, which means that the partnership itself would be responsible for paying the income tax. But that only happens under audit. Okay? In general, a partnership does not pay income tax. Everything passes through with a partnership. A partnership is a true pass-through entity. Profits and losses pass through to the partners or the owners of the entity, who are then responsible for reporting their respective shares of the partnership's income or loss on their individual tax returns. A partnership can have an unlimited number of partners and can have partners that are foreign or domestic, which means that a partnership can have partners that are non-resident aliens. It can have partners that are foreign corporations, foreign trusts, all of that. Partnerships are very flexible in that regard. A partnership must always have at least one general partner whose actions legally bind the business and who is legally responsible for a partnership's debts and liabilities. A partnership's annual tax return is filed on Form 1065, U.S. Return of Partnership Income. And you need to know this form number for the test. You're going to need to know these form numbers for the test. Partnership is filed on Form 1065. Partners are not employees of the business. General partners are not employees of the business. They're treated as self-employed. The general partners. They should not be issued a W-2. There are rare instances where sometimes a partner will be issued a W-2. You might actually encounter that in practice. But the IRS's position is that partners should not be issued a Form W-2 because they are not employees of the business. Instead, the partnership must furnish a copy of Schedule K-1 to each of its partners showing the income and losses allocated to him or her, to the individual partner themselves. That's where it's reported, not on a W-2, on the Schedule K-1. A partnership return must show the name and address of each partner and the partner's share of taxable income. Let's talk about a joint undertaking really briefly here. A joint undertaking merely to share expenses is not automatically a partnership. For example, co-ownership of a rental property is usually not considered a formal partnership unless the co-owners provide substantial services to the tenants. For example, if you have like a father and son and they own a residential rental property together, that's not necessarily considered a partnership if it's just a passive rental activity. You don't have to file a partnership tax return in that case. You can just split the profits and loss on the two tax returns. The father claims half, and then the son claims the other half. That's actually pretty commonplace. If it's just a passive rental activity, you wouldn't normally just treat that as a partnership. If it's just a passive rental, it's usually not considered a formal partnership unless the co-owners provide substantial services to the tenants. The IRS defines substantial services as services that are primarily for the tenant's convenience, such as regular cleaning, changing linens, or maid service. This would be something like a hotel or a bed and breakfast. In that case, the rental activity would not be classified as a joint undertaking because it would not be reported on Schedule E as a passive rental activity. Instead, it would be reported on Schedule C, or if the rental was owned and operated by more than one person, it would be classified as a partnership. And let me give you two examples. Cornell and Dolan are cousins who own a residential rental property together. Each owns a 50% interest in the rental. So they own a residential rental. They each own 50% and they're cousins. They don't have to be married. They could be just friends. They could be cousins. They could be father and son. This rule would apply in any of those cases. Okay? This is just a passive rental. They each own 50%. Cornell takes care of the repairs and Dolan collects and divides the rent. They do not have any other business with each other. The co-ownership of the rental property is not considered a partnership for tax purposes. Instead, they would just divide the income and expenses based on their ownership percentages, and each would report his respective share on Schedule E on his individual return. And what you do in this case, when you actually have a situation like this, you wouldn't report it on a partnership tax return unless the taxpayers wanted to report it that way. They certainly could if they wanted to. But if you wanted to just keep it easy and report it on two Schedule E's, you can, assuming that it's a passive rental activity and you're not offering substantial services to the tenants like daily maid service and daily breakfast and that sort of thing. If it's a passive rental and you just have month-to-month tenants in there, then you could do it like this. You could just report half of the rental activity on one Schedule E for one owner and the other half on the other Schedule E. And this is regardless of what kind of information statements they receive. So for example, let's say in this scenario, Cornell receives a 1099 to his Social Security number and it shows all of the rental income on his Social Security number. What you would have to do in your work papers is just allocate half of the income to one and half of the income to the other, and you just do it by hand. You would put it into your software and say, okay, so one half of the rental income is going to go to one owner and one half of the rental income is going to go to the other, right? And usually your software can allocate this for you, or if your software doesn't, then you could do it manually, right? You just keep track of it either on a spreadsheet or your work papers. Sometimes you have to do a little math, and that's okay. But this is typically what you would do if you have a passive rental activity that's owned by two people. Okay? Example number 2. Orlando and Suzanne are siblings. So this is a brother and a sister. They purchase a Victorian home in downtown New Orleans. They spend a substantial sum to divide the home into 4 separate units, which they then advertise as a bed and breakfast. So this is no longer going to be a passive rental. They offer maid service and daily breakfast to all of their guests. So that would qualify as substantial services. The IRS would classify their business as a hotel rather than a passive rental activity. Therefore, Orlando and Suzanne would be required to file a partnership return in order to report their earnings and profits. So in this case, this would trigger a partnership tax return filing if it was owned by both of them. Limited partnership. Now, a limited partnership is an LP, not an LLC. LP. We're going to talk about LLCs in a minute. This is a different thing altogether. A limited partnership is a partnership that has at least one limited partner in addition to its general partners. A limited partnership allows an investor to own an interest in a business without assuming personal liability or risk beyond the amount of his or her investment in the partnership. In order to have a limited partnership, you have to file paperwork with the state. A limited partnership is a state-level entity. So unlike a general partnership, which can be formed merely with a handshake between two persons, in order to be an LP, a certificate of limited partnership or a certificate of formation must generally be filed with the Secretary of State in the state in which the partnership chooses to do business. So whatever state the partnership is operating in, that's where they would file these forms. And you cannot have a limited partner in the mix unless you form a state-level entity. A general partnership is different. A general partnership doesn't have to have any formal paperwork. You can just form a general partnership with a handshake. You don't have to actually have any documents, technically. You don't have to have a written partnership agreement to form a general partnership. You can just, shake hands and say, oh, we're in business together. And then in that case, in order to file the partnership tax return, if it is a general partnership, the only thing you would have to do, at least on the federal level, is request an EIN, and that's it. And that's your partnership. But if you're going to have a limited partnership, you have to file paperwork with the state. You have to file articles of organization with the state. Every state is going to have different requirements. But for example, in order to form an LP, a limited partnership in California, a certificate of limited partnership, which is Form LP1, must be filed with the California Secretary of State, and the applicable filing fees must be paid. And I have an example in your slides. If you look down at the bottom of that form, you will see that it says general partner must sign. And this, of course, is not free. In order to form a limited partnership, that's going to cost money. A general partnership is free. You don't have to file any paperwork with the state. You might have to have a business license, but in some states or in some municipalities, that's free too. At least in Las Vegas, Nevada, where we're located, you could file a partnership business license. And if you operate that partnership from your home, for example, if it's like a husband-wife partnership, if my husband and I formed a partnership and we operated it from our home, the business license is free if it's a partnership in Las Vegas, Nevada. So we could potentially form a general partnership with zero costs. But in order to form a limited partnership, that costs money. You have to file articles with the state, either a certificate of limited partnership or a certificate of formation or whatever it is in your particular state, it's going to be different. But you're going to have to pay the filing fees to the Secretary of State in order to have limited liability for some of your partners if you're going to go this route. A limited partner generally has no obligation to contribute additional capital to the partnership. Remember this for the test. By definition, a limited partner has no obligation to contribute additional capital and therefore does not have an economic risk of loss for partnership liabilities. A limited partner may not sign the partnership tax return or represent the business before the IRS in their capacity as a limited partner. In most states, a limited partner is restricted regarding how active they can be in the management of the partnership. Let me explain this a little bit. What it means here by a limited partner has no obligation to contribute additional capital to the partnership. This means that a limited partner is generally just an investor. They don't have an active role in the management of the business. They're not supposed to anyway. The benefits of being a limited partner is that when you receive revenue from the partnership, if the partnership is profitable, right? If the partnership is profitable and you're a limited partner, then you receive revenue from that partnership and it's not subject to self-employment tax. It's a passive activity. So you're receiving that revenue and it's not subject to self-employment tax. You don't have to pay SE tax on that income. So that's a benefit if the partnership is profitable. But if the partnership does poorly, number one, you can't involve yourself in the management of the business. And then number two, you don't get to deduct the losses if the partnership does poorly, if you're just a limited partner. That's the drawback. So there's benefits if the partnership is profitable, but there's drawbacks if the partnership is losing money. So you can't have your cake and eat it too in that case. The other big benefit of being a limited partner is that your legal liability is limited. That's why it's called a limited partner. Let's say I invest in a limited partnership and I'm just a limited partner. I'm an investor. I put in $10,000. I'm going to try to see if this partnership does well. But as a limited partner, I don't have any say in the management of the partnership itself. But then my legal liability is also limited. Let's say the partnership starts doing poorly, and then they ask the investors to pitch in more money. Like, we need more money to operate. This is taking longer than we thought to turn a profit, whatever. The partnership can ask the limited partners to put in more money, but the limited partners can also refuse because they don't have any obligation to contribute additional capital. So if I put in initially $10,000 and then the partnership starts to do poorly, and I'm kind of thinking, maybe this partnership isn't going to do well, then my economic risk of loss is limited to that $10,000 that I put in. I could lose that. I could lose all that money, but they can't go after me for anything else. And they also can't force me to contribute additional capital after that. I can just say, okay, you got my 10,000 and that's all you're going to get. I'm allowed to do that. The other thing with a limited partner is that I don't have an economic risk of loss for partnership liabilities, and this includes legal liabilities. So for example, let's say the partnership is building something like a product, and that product ends up causing a legal liability, like it's defective and it hurts some of the customers, like, it's like baby strollers or something, and then it's discovered that the baby stroller is defective and there's babies getting injured or something, and then the company gets sued. In that case, I would have an economic risk of loss only up to the amount of my investment, and that's it. They could sue the partnership, they could and basically run it into the ground and force it into bankruptcy, but I would only be, my economic risk of loss would only be up to the amount of my initial investment. So once again, I could lose that $10,000, but they can't go after me for my personal assets. The general partners don't have that kind of protection, but the limited partners do. I would have a legal liability up until the amount of my investment, and that's it. That's the other big benefit of being a limited partner. Now, let me give you an example. Carter wants to open a dance club. He approaches his aunt, Marisol, for the funds. Marisol agrees to invest in her nephew's business, but she does not want to be involved in the day-to-day running of the club. After consulting a legal advisor, Carter and his aunt form a limited partnership, which is an LP. Per their partnership agreement, Marisol is a limited partner. She is an investor in the club and contributes $250,000 to establish the club. Carter is an experienced restaurateur and nightlife expert, so he runs the club. Carter is the general partner. And actually, this is pretty commonplace in the restaurant industry and like the nightclub industry. You'll have someone who usually is like a younger person who is very good at running clubs or has experience at running restaurants, and they're fine with being there until like 2 o'clock in the morning and running the club and dealing with the employees and everything else. And they're running the club, right? So they would be the general partner in that case. And then many times that restaurant or that nightclub will have passive investors that put in the money in order to get that club up and running. And many times these types of clubs or restaurants are really profitable, especially at the beginning. And the limited partners will get income from that activity. But there always has to be a general partner. And the general partner is the one that's running the show and has, the ability to take out loans and is the one signing the tax return and is the one signing, any kind of legal documents for the club. That's the general partner that does that. But this is actually pretty commonplace in the restaurant industry and the nightclub industry. You'll have one general partner that has a lot of experience in running this type of business. And then they'll have like silent partners or limited partners in the background that are just making money. But they put in money in order to start this business as limited partners, but they're just investors. They're not there running the club. LLP, a limited liability partnership. This is not the same as an LP. This is a different thing altogether. So a limited liability partnership is an entity that is formed under state law and is generally used for specific professional services, such as those offered by a law firm or a CPA firm. Some professionals form an LLP because the option to form an LLC is prohibited in their state for their particular business type. And this is the time where you really don't want to be giving advice to a professional, especially if you're not a legal professional like an attorney. Many times, if it's a professional services firm, they cannot operate under an LLC. So they cannot form an LLC in order to provide professional services. For example, in California and New York, LLCs cannot provide certain professional services. Doctors, CPAs, attorneys, veterinarians, engineers, architects, those sort of professional services firms cannot form an LLC for these particular business activities, but they are allowed to form an LLP and offer these professional services under an LLP. Typically, an LLP allows each partner to actively participate in the management affairs, but still provides limited liability protection to each partner. A partner in an LLP generally would not be personally liable for the partnership debts or malpractice of the other partners or the employees under the management of other partners, and would only be at risk for his or her own malpractice and his interest in the partnership assets. So an LLP is different than an LP. With an LP, the limited partners are not allowed to involve themselves in the day-to-day management of the business. But with an LLP, you will allow each partner to actively participate in management affairs. And typically they do. For example, doctors and lawyers, CPAs, very commonly will choose an LLP and operate as a limited liability partnership because they can't choose the LLC because it's prohibited in their state. Okay? So they'll choose an LLP instead, and then they will have active management in the business, but the LLP will give them limited liability protection, especially with regards to the actions of the other partners or the other employees in the business. I would have limited liability protection in that case if I was a partner in a limited liability partnership. For example, if I was a partner in a limited liability partnership and then one of my employees was committing fraud and I didn't know about it, or one of the other partners was committing fraud and I didn't know about it, and then the partnership later gets sued, then I would be at risk up to the amount of my investment in the business. The business could go under, but in that case, they couldn't go after my personal assets if I wasn't the one actually committing those acts and I had no knowledge of those acts. So I would have limited liability in that case. Example, Paul and Barry are licensed attorneys in California who decide to go into business with each other. They form an LLP by registering their business with the California Secretary of State. Once they complete their registration, they can open an office and begin accepting new clients. For tax purposes, their business will be taxed as a partnership, and they will be required to file a Form 1065 every year. In a limited liability partnership, the partners enjoy some protection against personal legal liability. C corporations. A C corporation is considered an entity separate from its shareholders and must elect a board of directors who are responsible for oversight of the company. Now, most of what you're going to see in practice as an enrolled agent are small C corporations. You're not going to see C corporations that have 1,000 shareholders and, a board of directors where it's a dozen people. Generally, you're going to see small C corporations. They're filing the 1120. That's a C corporation. That's what they have to file. And it's one or two people. One shareholder, owner, maybe a married couple, maybe 3 or 4 people. That's what you're going to see for the most part as an enrolled agent. And those are the returns that you're going to be filing in your actual practice. But you have to know the rules for large C corporations for the test, because they're going to ask you about things that affect large C corporations. For example, when a C corporation has a stock sale, when you have dividends that are issued to the stockholders, that sort of thing. You have to know the rules for C corporations in a very general way. But for the most part, what you're going to be seeing in practice are very small C corporations with just one shareholder, employee, maybe 2. Okay? If you do have a small C corporation, though, it still has to have a board of directors, even if it's just one guy. So a corporation conducts business, realizes net income or loss, and distributes profits to shareholders. Most major companies are organized as C corporations. So all the companies that are publicly traded on the New York Stock Exchange and the NASDAQ, those are all C corporations. They have to be. That's the only way that they can sell millions of shares of stock on the open market and have investors that are both foreign and domestic. They have to be C corporations in order to do that. A C corporation must file an annual income tax return on Form 1120. That's the income tax return for a C corporation. And C corporations have to report their net income and losses and pay tax on their income, just like a normal, natural person would. C corporations are taxed on their income, just like humans. Okay? So they're subject to entity level income tax. Its after-tax profits may be taxable income to its shareholders when distributed as dividends, resulting in double taxation. A corporation does not receive a tax deduction when it distributes dividends to its shareholders, and shareholders cannot deduct any losses of a corporation. If a C corporation has a loss, it doesn't transfer to the shareholders. A lot of newer preparers get confused by that. If you have an S corporation that has losses, those losses get passed through to the shareholders. But a C corporation, the losses don't get passed through. A C corporation is not a pass-through entity. So if a C corporation has massive losses, those don't transfer to the shareholders. The losses remain with the corporation. It's like it's its own person. It's as if it's a separate person, completely separate from its shareholders. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. For example, the business deductions are similar, not exactly the same, but, a corporation can take a deduction for business meals. A corporation can take a deduction for, business supplies, for cost of goods sold, all of that. It's similar, not exactly the same, but the business expenses are similar. But it is allowed certain special deductions. C corporations are now taxed at a flat rate. The Tax Cuts and Jobs Act permanently eliminated the graduated tax rates for C corporations. All C corporations are now taxed at a flat rate of 21%. And you need to know that for the test. Before the Tax Cuts and Jobs Act, corporations had a graduated tax rate, just like individual humans, natural persons did. And then the Tax Cuts and Jobs Act did away with that. And now C corporations are taxed at a flat rate of 21%. You need to know that for the test. Remember that. S corporations. An S corporation is a distinct form of entity organized as a corporation for legal purposes, but elected with the IRS for tax purposes. When I talk about S corporations, I try really hard to get the verbiage right. You don't form an S corporation. An S corporation is never formed. You form something else, like a C corporation at the state level, or an LLC, and then you elect a tax treatment. An S corporation is a tax election only. It doesn't change the nature of the underlying entity. So for example, you can form a corporation and then make an S election. You can also form an LLC and make an S election. And if you can believe it, you can form an LLP and also make an S election. You can actually form many different types of state level entities and make an S election because it's just a tax treatment. An S election is a tax treatment. You don't ever form an S corporation. You form something else and then you make an election to be treated as an S corporation for tax purposes only. This is a tax election only. For federal income tax purposes, an S corporation is generally not subject to income tax. Generally, not always. We're going to talk about the times that an S corporation is subject to income tax. Entity level income tax, where the S corporation itself has to pay income tax. And we're going to talk about that more when we get to the S corporation chapter, because you need to know when an S corporation will be subject to income tax on the Form 1120S, when an S corporation actually has to pay income tax. However, most of the time, S corporations are not subject to entity level income tax. Instead, its income, losses, deductions, and credits are passed through directly to its shareholders in a manner similar to a partnership. Not exactly the same, similar to a partnership. However, while not common, the S corporation itself may be responsible for income tax on certain built-in gains and passive investment income, and we will cover these special rules that apply to S corporations in a later unit. The next webinar covers limited liability companies, or LLCs, and qualified joint ventures. In this webinar, we cover limited liability companies, which are LLCs, and qualified joint ventures. LLCs. Now, finally, we're going to talk about LLCs. An LLC is a limited liability company. It's another type of business entity that can be formed under state law. Depending on whether it has a single owner or multiple owners, an LLC will be treated for federal tax purposes either as a disregarded entity. That's if it has one owner, and that owner forms the LLC and does nothing after that. It's a disregarded entity if it's a single owner, and then it's formed and the owner makes no other elections after that. That's a disregarded entity. It can also be treated as a corporation. An LLC can be treated as a C corporation or as an S corporation if the owners decide to make that election. They can make an election to be treated as a C corporation or as an S corporation, or as a partnership if the LLC has more than one owner. Most LLCs in the United States are taxed as partnerships. If a multi-member limited liability company, an MMLLC, is treated as a partnership for tax purposes, it must file a Form 1065 annually, and one of its owners or members must sign the return. A professional service limited liability company, or PLLC, is a type of limited liability company that is owned and operated by licensed professionals such as doctors, lawyers, engineers, and CPAs. PLLCs are not available in every state and have ownership restrictions and can generally only offer services related to its profession. Only about half of the U.S. states offer the option of a professional limited liability company. This would be for a professional services firm. So if you have a professional services firm, like it's a doctor, a veterinarian, a lawyer, an engineer, a CPA, most of the time they don't have the option to form an LLC in their state unless the state offers a professional service limited liability company option. And these are not available in every state. Only about half of the U.S. states will allow a professional services firm to form a PLLC. Let's talk about qualified joint ventures. Often, a small business is operated by spouses without incorporating or creating a formal partnership agreement. We're just talking about spousal-owned businesses here. The qualified joint venture is a business that's owned and operated by two spouses, a married couple. The business is usually considered a partnership whether or not there is a formal partnership agreement. So a partnership is the default. A qualified joint venture is an election, always, because both spouses have to agree and they also have to file jointly in order to make this election. If they don't agree and they don't file jointly, then it's not a qualified joint venture. It's always an election. The default is a partnership. If both spouses materially participate as the only members of a jointly owned and operated business, the business can be treated as a qualified joint venture or QJV. The spouses then must file separate Schedule Cs and separate Schedule SEs. You have to file two. And the reason why you have to file two is because if you only file one Schedule C, then only one Schedule SE is going to be generated by your software. And both spouses have to have a Schedule SE because both of them have self-employment tax that's going to be allocated to their Social Security and Medicare accounts. You don't want to have a situation where you have a business that's operated by two spouses where you're only allocating all of the Social Security and Medicare tax to one of them if they're both running the business together. You want to make sure that both of them get Social Security and Medicare tax allocated to them. What happens if you don't do that is one of those spouses is going to go down to the Social Security office and they're going to look at their Social Security statement and realize that they're not getting allocated Social Security and Medicare. And sometimes it'll make it so that they can't claim Social Security and Medicare for themselves when they turn 65. So you never want to do this. You always want to make sure that if it is a qualified joint venture and both of the spouses are actually running the business, that you file separate Schedule Cs and separate Schedule SEs, where the self-employment tax gets calculated for both of the spouses. Now, this option is only available to married couples who file a joint tax return. They have to file jointly in order to make this election. A partnership would be required to file a partnership tax return if the entity is a state-level entity, such as an MMLLC. This is a multi-member LLC. In general, if the spouses form an LLC and both of them are owners, they cannot file as a qualified joint venture once they form a state-level entity. There is a narrow exception in the law for married couples who live in a community property state. Married couples who co-own and operate an MMLLC, that stands for multi-member LLC, once again, in a community property state may still file as a qualified joint venture. Community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. If they are domiciled in one of those states and their LLC is organized and formed in one of those states, then they can file as a qualified joint venture if it's a married couple and they have an LLC. But if they have an LLC and it's a married couple and they are not in one of these states, then the qualified joint venture is no longer available to them. And I'm going to show you where it says this on the IRS website, so you believe me, because people argue with me about this all the time. So I'm going to show you where this is on the IRS website. Here I am on the IRS website, and at the top of the page, it says Election for Married Couple Unincorporated Businesses. An unincorporated business jointly owned by a married couple is generally classified as a partnership for federal tax purposes. So the qualified joint venture is always an election. The default is a partnership, even if it's a business that's jointly owned and run by a married couple. Because a business jointly owned and operated by a married couple is generally treated as a partnership for federal tax purposes, the spouses must comply with filing and record-keeping requirements imposed on partnerships and their partners. Married co-owners failing to file properly as a partnership may have been reporting on a Schedule C in the name of one spouse, so that only one spouse received credit for Social Security and Medicare coverage purposes. You might not think this is a big deal, but when taxpayers reach, 62, 63, 65, and they're getting close to being able to claim Social Security, if you've been doing this and you've just been filing on one Schedule C for them, and the other spouse wants to go claim Social Security for themselves, they're going to get very upset if this wasn't done properly. You want to make sure that if it's a married couple business and both of them are working in the business, that both of them are getting credit for Social Security and Medicare. The only way to do that is to either file a partnership tax return, and then half of the Social Security and Medicare tax is going to get automatically allocated to either one, or if you're filing as a qualified joint venture, you need to file 2 Schedule C's and 2 Schedule SEs. The Schedule SE is where the Social Security and Medicare tax gets allocated to both spouses or either spouse. That's where the allocation happens, is there on the Schedule SE. The definition of a qualified joint venture is a joint venture that conducts a trade or business where the only members of the joint venture are a married couple who file a joint return. Once again, they have to file jointly. If they file MFS, they can't make the qualified joint venture election. Both spouses materially participate in the trade or business, and both spouses elect not to be treated as a partnership. If you go down a little bit, it says a business owned and operated by the spouses through a limited liability company does not qualify for the election. Only businesses that are owned and operated by spouses as co-owners and not in the name of a state law entity. This would include limited liability companies. This would include LPs, LLPs, any kind of a state law entity. Once you form a state law entity, you cannot qualify for the qualified joint venture election except to married couple businesses in community property states. And there's the Rev Proc right there if you want to read it. It's Revenue Procedure 2002-69 and Revenue Procedure 2002-2, which means that the IRS has actually issued this guidance since 2002. So it's been 20 years that married couple businesses were allowed to make a qualified joint venture election in community property states. And I'm going to show you the Rev Proc so you can see it. As you can see here, I'm on Revenue Procedure 2002-69. This is official IRS guidance. And this is the section right here, the section 3, that talks about the exception for community property states. So it says here, this revenue procedure provides guidance on the classification for federal tax purposes of a qualified entity. They're talking about qualified joint ventures. A business entity is a qualified entity if the business entity is wholly owned by a husband and wife or 2 spouses in the case of a same-sex couple as community property under the laws of a state, a foreign country, or a possession of the United States. No person other than one or both spouses would be considered an owner for federal tax purposes. What this means is that once you add another person into the mix of ownership, then it can't be treated as a qualified joint venture anymore. So, for example, if you have a married couple and they are the owners of the business, and then you add a third person, like let's say you add an adult child as an owner or a sibling of one of the owners or whatever, it doesn't matter. Once you add a third person to the ownership of the business, at that point, the qualified joint venture election is not available anymore, regardless of what state you live in or whether it's a community property state or not. Once you have a third person that's not the spouse, then it's not a qualified joint venture anymore, and you have to file a partnership tax return, period. Okay? This is only available to married couples where the only owners in the business are the spouses themselves. And then lastly, the business entity is not treated as a corporation. So it's an unincorporated business owned and operated by a married couple. If they're in a community property state, then they can still file as a qualified joint venture on 2 Schedule C's and 2 Schedule SEs, even if they form a state law entity. But once they form a state law entity, if it's not a community property state, then they have to file a partnership tax return. And I wanted to show you on the Schedule E, you can make a qualified joint venture election on the Schedule E as well as the Schedule C. If you look right here in the middle of the page, it says check the qualified joint venture box only if you meet the requirements to file as a qualified joint venture. So you can actually make a qualified joint venture election on the Schedule C as well as the Schedule E. There's a box for you to do it here as well. And let me give you two examples. Roger and Joanna live in Hawaii, where they operate a small business together as husband and wife. They qualify for and treat their business as a qualified joint venture and file on 2 Schedule Cs. Later in the year, they decide to form an LLC. They must file a partnership tax return, which is the Form 1065 for their business, starting with the date of the formation of the LLC. So as soon as they form that LLC, that's when the filing requirement for a partnership begins. They can no longer treat their business activity as a qualified joint venture because Hawaii is not a community property state. Example number 2. Grant and Natalie are married and file jointly. They live in Texas and run a small grocery store together as a qualified joint venture. During the year, they form an LLC for liability protection. Since Texas is a community property state, they are allowed to continue treating their business as a qualified joint venture and report their income and loss on 2 Schedule Cs. The next video covers farmers and exempt organizations. In this webinar, we cover farmers and exempt organizations. Farmers. We're going to talk a lot about farmers. We have a unit dedicated just to farmers. This is the only unit in the book that is dedicated to a specific activity, a business activity, because there's a lot of special rules for farming businesses specifically. Farming businesses are primarily engaged in crop production, animal production, or forestry and logging. They may include stock, dairy, poultry, fish, fruit, and tree farms, as well as plantations, ranches, timber farms, and orchards. It is the nature of the activity, not the entity type, that determines whether a business qualifies as a farming business. So, for example, a farmer can be a sole proprietor. If it is a sole proprietor, they file a Schedule F, not a Schedule C, and attach it to their Form 1040. But a farming business can also be a partnership. It can also be a corporation. And then those special rules for farming businesses, like specifically rules like for NOLs, right? So if you have a net operating loss and it's a farming business, if it's a corporation that has a net operating loss and it's a farming corporation, then they're allowed to carry back their losses, when most business types do not get to do that anymore, but farmers do. And that's true whether it's organized as a corporation, a sole proprietorship, or a partnership. So Congress has enacted many tax laws that are specific to farming, and we're going to cover these in detail in a later unit. Tax-exempt organizations. Tax-exempt organizations are also called nonprofit entities. The Internal Revenue Code, IRC Section 501C. Notice that there's not a 3 after this because there's a lot of tax-exempt entities out there, and not all of them are 501c3s. 501c3s are charities, but not all tax-exempt organizations are charities. There's a lot of different types of tax-exempt organizations out there. But 501c, this is the section of the Internal Revenue Code that outlines the requirements for tax-exempt organizations. These organizations must have a tax-exempt purpose, and none of their earnings may be used to benefit any private shareholder or individual. Nonprofit organizations may be created as corporations, trusts, or unincorporated associations, but never as partnerships or sole proprietorships. You have to remember this for the test. A tax-exempt organization can never be a partnership or a sole proprietorship. You can't just say, oh, I'm tax-exempt. If you're a sole proprietor. That's not how it works with tax-exempt organizations. A tax-exempt organization can be a corporation, a trust, many of them are charitable trusts, or an unincorporated association, but never as a partnership and never as a sole proprietorship, if it's a tax-exempt organization specifically. The next webinar covers employer identification numbers. In this video, we cover employer identification numbers. EIN, an employer identification number, is used for reporting purposes. Unlike Social Security numbers that are assigned to individuals, EINs are assigned to business entities. If a sole proprietor has no employees, the business owner is normally not required to obtain an EIN, although I do recommend it. I got my EIN immediately after I started doing bookkeeping and tax returns. I got my EIN right away. and I haven't used my social security number on a W-9, when you give your W-9 to a vendor, I haven't used my social security number on a W-9 in 20 years. I always use my EIN. I try to hand out my social security number as little as possible, as little as possible. I always recommend that sole proprietors obtain an EIN and use that anytime they have any kind of business activity that would require giving out a taxpayer identification number. I always tell them to use the EIN. An EIN can be requested by a sole proprietor who simply wishes to protect his social security number for privacy reasons. This way, a sole proprietor can provide his EIN rather than his social security number to companies that need to issue a Form 1099 NEC for independent contractor payments. If a sole proprietor decides to form a business entity, such as a partnership or corporation, he will be required to request an EIN for each separate entity. A partnership has to have its own EIN. A corporation has to have its own EIN. A trust has to have its own EIN. An estate has to have its own EIN. All of those entity types are considered completely separate. And for example, if I were to form a sole proprietorship and then a partnership the next month and then a corporation the month after that, I would need a separate EIN for all of those activities. They're all considered separate entity types. So you would have to request an EIN for all of those. You cannot use the same EIN for different entity types. Okay? A business must apply for an EIN if it has any of the following. If the business pays employees, you cannot run payroll under your social security number if you're a sole proprietor. You cannot do that. And this is true even if it's someone who hires just household employees. Like, for example, if you hire a nanny or a chauffeur to work in your home. I know that that's not technically a business, but anytime you hire employees for any reason, you have to request an EIN. If the business operates as a corporation, exempt organization, trust, estate, or partnership, you would need to request an EIN for each one of those separate entities. They would all be considered separate. If the business files any of these tax returns, employment taxes, excise taxes, alcohol, tobacco, or firearms. If the business withholds taxes paid to a non-resident alien, or if the business establishes a pension, profit sharing, or retirement plan. For example, if you're a sole proprietorship and you're doing really well, and now you want to establish a retirement plan for your business. Let's say you want to establish a retirement plan like a solo 401k. You want to set up a 401k for your business because your business is doing really well and you would like to shield a lot of your income from tax by socking it away in a retirement plan. In order to do that, you have to request an EIN, even if your business does not have any employees. If you're a sole proprietor and you want to establish a retirement plan for yourself, for your own business, then you have to request an EIN. And it's really easy to request an EIN online, right on the IRS website. You can request an EIN that way, and it's really simple. You just have to make sure that when you get to the end, you print that page that has the EIN on it. Don't forget to do that. So you got to make sure you print that last page that has the EIN on it. And then usually the IRS will mail you something with the EIN on it, but you can't guarantee that. You want to make sure you print that last page at the end if you are requesting the EIN online on the IRS website.
The next webinar covers reporting requirements for businesses. In this video, we cover reporting requirements for businesses.
Reporting requirements. Businesses are subject to a number of reporting requirements, including the following. Form W-2 is what you have to file if you have employees, and these have to be given to the employees no later than January 31st of the following year. If you have independent contractors, you have to file Form 1099 NEC. This stands for non-employee compensation. If you have independent contractors, and these also have to be given to the independent contractors by January 31st of the following year. The Form 1099 miscellaneous is for basically every other type of payment that your business might make. Amounts that are reported on the 1099 miscellaneous include payments of $600 or more for rents, prizes and awards, crop insurance proceeds, and certain medical and healthcare payments. Royalties over $10. If you'll notice, this threshold is a lot lower. The threshold for royalties, if your business pays royalties, is only 10.
In this video, we cover reporting requirements for businesses.
Reporting requirements. Businesses are subject to a number of reporting requirements, including the following. Form W-2 is what you have to file if you have employees, and these have to be given to the employees no later than January 31st of the following year. If you have independent contractors, you have to file Form 1099 NEC. This stands for non-employee compensation. If you have independent contractors, and these also have to be given to the independent contractors by January 31st of the following year. The Form 1099 miscellaneous is for basically every other type of payment that your business might make. Amounts that are reported on the 1099 miscellaneous include payments of $600 or more for rents, prizes and awards, crop insurance proceeds, and certain medical and healthcare payments. Royalties over $10. If you'll notice, this threshold is a lot lower. The threshold for royalties, if your business pays royalties, is only $10. But if it's payments for rents, prizes, crop insurance proceeds, that threshold is $600. And then on the 1099 miscellaneous, there's a special box for proceeds paid to an attorney's office when the total amount is $600 or more. And there's a filing requirement here if it's an attorney's office, even if the attorney is incorporated. You still have to send them a 1099, even if it's a corporation, whether it's an S Corp or a C Corp. Reporting requirements. Except for incorporated attorneys, payments to corporations are generally exempt from Form 1099 reporting requirements. Forms 1099, whether it's the miscellaneous or the NEC, should only be used for payments that are made in the course of a trade or business. Personal payments are not reportable. You do not report personal payments on either one of these forms. You only report payments that are done in the course of a trade or business. A business should only include payments made by cash, check, or ACH transfer or other direct means on Form 1099 miscellaneous or 1099 NEC. Credit card payments, if you make payments by credit card, including third-party network transactions like PayPal or Stripe or Square, must be reported on Form 1099-K by the payment settlement entity and are not subject to reporting on 1099 miscellaneous or 1099 NEC. If your business pays a vendor with a credit card or using PayPal or Square or some other third-party network transaction, you should not be sending a 1099 miscellaneous or 1099 NEC for those payments. Those are subject to the Form 1099-K requirements, and then the third-party network is the one that's supposed to be sending those out. If you send them a 1099 miscellaneous or a 1099 NEC, generally what's going to happen is you're going to duplicate those payments, and that causes problems for the vendor. So you shouldn't do that. If you make a payment with a credit card or using a third-party network like Square or PayPal, those are not subject to the 1099 miscellaneous or 1099 NEC reporting requirements. And I'm going to show you where it says that in the instructions. Here I am on the instructions for the forms 1099 miscellaneous and 1099 NEC. And I wanted to show you where it says the exceptions for when you have to send these out. It says right here at the bottom of the page, some payments do not have to be reported on Form 1099 miscellaneous, although they may be taxable to the recipient. Payments for which a Form 1099 miscellaneous is not required include all of the following. Generally, payments to a corporation, including a limited liability company that is treated as a C or an S corporation, do not have to be reported on the Form 1099 miscellaneous or the 1099 NEC. So if your vendor, the vendor that you're paying, is a corporation, unless it's an attorney, if it's an attorney, you still have to send them a form if you make payments to them, if it's an incorporated attorney. But any other type of C corporation or S corporation, you don't have to send them a 1099 NEC or a 1099 miscellaneous. And then down here, if you see it says Forms 1099K, if the payments are made with a credit card or payment card and certain other types of payments, including third-party network transactions, they must be reported on Form 1099K by the payment settlement entity. So that means that PayPal and Stripe and Square, they're the ones that are responsible for sending out the 1099K, not you, if you make payments to a vendor using one of these third-party networks. They're not subject to reporting on Form 1099 miscellaneous, and then you can see the separate instructions for the Form 1099K. Okay? So you don't have to send any of these forms out if you're paying a vendor with a credit card or with a third-party network. In that case, the third-party network is responsible for sending them a 1099K. And let me give you an example. Stephanie hires Robert, a professional painter, to paint the exterior of her home. The job costs $3,500. Stephanie is not required to report the payment to the painter because it is for her personal residence. This is not a business transaction. She's just having the painter paint her personal residence. Since it was a personal payment, she cannot deduct the cost on her income tax return. However, the painter is still required to report the income on his income tax return. The following year, Stephanie calls Robert again to paint the interior of her business office, which she owns. The painting job cost $2,000. Since this cost is a business expense, Stephanie is required to issue a Form 1099 NEC to the contractor. So for the first payment, that's a personal payment. She doesn't have any reporting requirements there. But the second payment is a tax-deductible transaction for her. She's hiring him to paint her business office. So she would have to send out a 1099 NEC to the contractor for that one. Form 1099K. The Form 1099K is the payment card and third-party network transactions. This is a type of IRS information return that's used by payment settlement entities like PayPal, Square, Stripe, Amazon, Lyft, that sort of thing. It's used to report online payment transactions. Note, rideshare drivers, like those that work for Uber and Lyft, generally receive a Form 1099K for their driving services since the payments made to them are processed by a third-party network. The 1099K includes a breakdown of the driver's annual gross earnings. So the 1099K always includes the gross. It's the gross sales of that person. So for example, if I was selling on Amazon, if I was an Amazon seller, then my 1099K would include all of my gross sales, and it would also include sales tax, which is not revenue to me because Amazon takes that money and remits it. So the 1099K is not necessarily accurate because it includes all of the gross sales, including the sales tax, tips, whatever else. So many times you're going to have to do a little bit of adjusting and bookkeeping and cleaning up because the information that's on the 1099K
is not going to necessarily be accurate to what you need to put on the tax return. It's just the gross sales, including sales tax and everything else that the person had. If they were selling on eBay or Amazon, or if they were driving for Uber or Lyft. The 2023 Form 1099-K reporting threshold is either $20,000 in gross earnings and or 200 transactions. For example, if I had 200 rides, if I was driving for Uber, then I would get a 1099-K even if my gross sales were less than $20,000. But if I had more than $20,000 in gross earnings, regardless of where I was selling, if I was selling on eBay or Amazon or whatever, then I would get a 1099-K as well. It's either $20,000 in gross sales or 200 transactions. A driver would typically receive a 1099-K if they earned more than $20,000 in fees and provided more than 200 rides to passengers.
Cash transactions. Now let's talk about the Form 8300. This is for business transactions only, and this is a Title 31 requirement. This is not a requirement that's in the Internal Revenue Code, but it applies to businesses that accept large amounts of cash. This does not apply to personal transactions. It does not. It only applies to business transactions. If a business receives a cash payment of over $10,000, they are required to report that cash transaction on the Form 8300. The business must also provide a written statement to each person or customer named on any Form 8300 that is filed. The statement must be provided to the customer no later than January 31st of the following year. For the purposes of this rule, cash includes the coins and currency of the United States, cashier's checks, bank drafts, traveler's checks, as well as cash in any foreign currency, if it's the equivalent of 10,000 US dollars. Cash does not include bank wire transfers, credit card transactions, ACH transactions. This would be like transactions made with a debit card, or amounts paid with personal checks. So a cashier's check has to be reported, but a personal check does not. And I'm assuming that's because a personal check is very easy to trace, right? It's a personal check is a bank draft from your own checking account. But if it's a cashier's check specifically, and you receive it in the course of business, and it's more than $10,000, you have to file the Form 8300 within 15 days after you receive the cash. And this is what the form looks like. It's the Form 8300, Report of Cash Payments over $10,000 received in a trade or business. Okay? Once again, if it's a personal check, this does not have to be reported. And this personal check is just a sample from the U.S. Department of Homeland Security. I found an image on there. This is a personal check up at the top. It has your name, your address, your telephone number on it. That's a personal check. That doesn't have to be reported. If it's $10,000, if it's $20,000, if it's $100,000, this doesn't have to be reported if you receive a personal check. But if you receive a cashier's check has to be reported if it's more than $10,000. Now, a very common type of cash transaction where you might have a large amount of cash changing hands is the sale or purchase of a vehicle, a used car or a new car. Many times that's where you have a large cash transaction. And the reporting requirements depend on whether or not it's a business transaction or a personal transaction. So let me give you a couple of examples. Example number 1. Adams Used Autos, LLC, is a small family-owned car dealership. On January 6, 2023, Jennifer Jones buys a used car from Adams Used Autos and pays $17,000 in cash. Whether she pays with actual cash, like green currency dollars, or whether she pays with a cashier's check, this is going to be treated the same. It's over $10,000 in cash. The dealership asks Jennifer for her driver's license and verifies her identification in order to get the necessary information to complete Form 8300. Adams Used Autos must file the Form 8300 no later than January 21st, 2023. This is 15 days after the purchase. That's when the business has to file Form 8300. The dealership must also send a statement to Jennifer by January 31st, 2024. That's the following year. So the 8300 has to be filed by the business within 15 days. But then to give the statement to the buyer, Jennifer Jones, that doesn't have to be done until the following year. Example number 2. Sheena is an elementary school teacher. She decides to sell her personal vehicle. She places an ad in her local newspaper listing the car for $12,500. She finds a buyer for the car who pays her $12,500 in cash a week later. Sheena does not have to report the sale on Form 8300 because she is not a professional car dealer. She's a teacher and she's just selling her car to a private party buyer, like on Craigslist or whatever. So she doesn't have to report this anywhere. It's not a taxable event. And, she doesn't have to file the Form 8300. She's not a professional car dealer, and the transaction is not a business transaction. This is just a personal transaction, so she doesn't have to file anything.
The next webinar covers worker classification. In this webinar, we cover worker classification.
Worker classification. Worker classification is a hot button issue for the IRS. Businesses are responsible for withholding and paying income, employment, and food taxes, as well as reporting payments to independent contractors. So businesses must accurately determine whether a person they pay is an independent contractor or an employee. A business is generally not required to withhold or pay taxes in connection with payments to independent contractors. However, it must understand the relationship that exists with each person it pays to perform services. The IRS, or the federal government, classifies workers into 4 different categories. A person performing services for a business may be an independent contractor, an employee, a statutory employee, or a statutory non-employee. And you need to know the difference between all 4 of these. Statutory employees. Now, some workers are classified as statutory employees. The first time you see one of these, it's a little bit jarring, okay? Statutory employees are unique because they are issued a W-2. Statutory employees get a W-2, but they report their wages, income, and allowable expenses on Schedule C, just like self-employed taxpayers. What happens when you put a statutory employee into your software is your software will generate a Schedule C for these types of workers. Now, they're a very narrow group, the types of workers that can be classified as statutory employees. They're usually salespeople or other employees who work on commission. And they're not commonplace, but I have seen several in my practice career, and the ones that I have seen have always been full-time life insurance salespeople. Full-time life insurance salespeople are the ones that I've seen personally. So examples of statutory employees include full-time life insurance salespeople, traveling salespeople, certain commission truck drivers, and certain home workers who perform work on materials or goods furnished by the employer. If a person is a statutory employee, the statutory employee in box 13 of their Form W-2 should be checked. These employees are really unique because they're only treated as employees for Social Security tax purposes. The employer withholds Social Security tax, but they're treated as self-employed for every other purpose. And that's why they file the Schedule C along with their income tax return. They're very unique. And this is what it looks like. When you get a W-2 that's a statutory employee, this box is checked. Box number 13. There's a little X right there or a check mark. And let me give you an example. Avery is a full-time life insurance salesman working for Provident Life Insurance Company. Avery sells life insurance and annuity contracts, and he works out of a business office that he rents himself. Provident Life Insurance issues Avery a Form W-2 with a box for statutory employee checked. Avery will report his income and loss on a Schedule C, but a Schedule SE will not be generated by his software. He doesn't pay self-employment tax. Because if you look right here on the W-2, the Social Security tax and the Medicare tax has already been withheld and paid by his employer. But the federal income tax box is empty. Okay, the federal income tax box is empty. And that's because they don't pay federal income tax on the Form W-2. They're only treated as employees for Social Security tax and Medicare tax purposes only. The federal income tax they're going to pay on their own tax return. Okay, they're very weird, but if you've been in this business long enough, you're going to see one of these. Eventually, one of them is going to walk through your door. And you can tell that they're statutory employees because that box is checked, the box 13. This is what their W-2 looks like. That box is going to be checked. No federal income tax will be withheld, but there will be Social Security and Medicare tax withheld in these two boxes right here. So a Schedule C will be generated by the software, but not a Schedule SE because the Social Security and Medicare taxes have already been withheld and remitted to the IRS by his employer. Avery is classified as a statutory employee. Statutory non-employees. Now, these are workers that are treated as non-employees by statute. They're independent contractors automatically, even if they only work for one company. So in that regard, they're unusual. There are three categories of statutory non-employees: direct sellers, licensed real estate agents, they're talking about realtors, and certain companion sitters. They are treated as self-employed for federal tax purposes, including income and employment taxes, if payments for their services are directly related to sales rather than for the number of hours worked, and services are performed under a written contract providing that they will not be treated as employees for federal tax purposes. Compensation for statutory non-employees are reported on Form 1099 NEC. The taxpayer then reports the income on Schedule C. And let me give you two examples. These are the two that I think you're going to see the most often, is a direct seller and real estate agents, like realtors. Eugenia works full-time as a real estate agent for Trustee Realty Services. She visits the realty office at least once a day to check her email and her messages. She manages dozens of real estate listings and splits her real estate commissions with Trustee Realty. She sets her own schedule, but does not work for any other real estate company. Eugenia is classified as a statutory non-employee. Trustee Realty issues Eugenia a Form 1099 NEC for her real estate commissions. Eugenia files a Schedule C to report her income and expenses from her realty business. So even though she's only working for one company, she still gets treated as an independent contractor if she's a licensed realtor. Example number 2. Mandy sells cosmetics, perfumes, and personal products as an independent sales representative of Mary Care. Mandy's customers pick products directly out of catalogs. Mandy then orders the products and delivers them to her customers personally. Sometimes she will host Mary Care parties at her home where customers can socialize and try different products. Mandy earns a 40% commission on her product sales. She is not an employee of Mary Care. She will file a Schedule C to report her income and expenses. So this would be like Mary Kay, Avon, that sort of thing. If they're selling products out of catalogs and they're independent sales consultants or representatives, then they're going to be treated as statutory non-employees as well and file a Schedule C for their sales. Employing family members. Now, there are special rules when you hire family members. If it's a child working for a parent, if the parent's business is a sole proprietorship or a partnership in which each partner is the child's parent, the payments for the child's services are subject to income tax withholding. However, if the child is under the age of 18, wage payments are not subject to Social Security and Medicare taxes. These are also called FICA taxes or payroll taxes. This is one of the best tax planning devices for a sole proprietorship or a partnership where the only owners are the parents. Now, if it's a corporation, this doesn't apply because a corporation is a separate legal entity. So if you hire your child to work in your corporation, whether it's an S corporation or a C corporation, they're not working for you. They're working for your corporation. Okay? Now, if they're working for your sole proprietorship, though, or your partnership where the only owners are a married couple, the spouses, the child's parents, then the wages that you pay to your own child, if the child is under the age of 18, are not subject to Social Security or Medicare. They're basically tax-free if they're under the standard deduction amounts. So this is a great tax planning device for parents who hire their own children. But if you hire them to work in your corporation, that's not the same thing. A corporation is a separate legal entity, so they don't get this big tax break if you hire them to work in your corporation. But if it's a sole proprietorship or a partnership where the only owners are the parents of the child, then none of the wages are going to be subject to payroll tax. If the child is under 21, the payments are not subject to FUTA, which is the federal unemployment tax. This special rule for employee children does not apply if the business is organized as a corporation. Now, if you hire your own spouse, the wages for the services of a spouse are subject to income tax, Social Security, and Medicare, but not FUTA tax if the business is a sole proprietorship. However, FUTA tax is applicable if the spouse works for a corporation or a partnership in which the employing spouse is a partner. Examples. Kendra is 17 and works part-time as an administrative assistant for her father's company, Real Time Sporting Goods, Inc. Her father is the sole shareholder and owner. Since Real Time Sporting Goods is organized as a C corporation, Kendra's wages are subject to all payroll taxes, including Social Security, Medicare, and FUTA. So this would be the same if it was an S corporation too. The child is working for the corporation, not directly for the parent. So their payroll taxes are going to apply, and FUTA tax is going to apply too. Example number 2. Deborah and Richard are married. They are partners in the Sandwich Shop, a small restaurant that they co-own and operate. Their daughter, Angie, age 16, works as a hostess on the weekends. Her parents pay her $15 an hour, which is a reasonable wage in their locality. Deborah and Richard must withhold income tax on Angie's earnings. However, because of her age and because she is working directly for her parents, her wages are not subject to Social Security, Medicare, and FUTA, which is the federal unemployment tax. So if they pay her less than the standard deduction amount, her wages are basically going to be tax-free because she's 16. She's still a minor. So this is a great tax planning device for sole proprietorships and partnerships where they hire their own children. Now let's talk about the FUTA. The federal unemployment tax provides for payments of unemployment compensation to workers who have lost their jobs. Basically, if you hire an employee and then you fire them, then the employee can claim unemployment. That's the FUTA tax. But you are responsible for paying the FUTA tax on the employee's wages. The employee doesn't pay this tax. The business does. A business reports and pays FUTA tax separately from federal income tax and Social Security and Medicare taxes. It's a separate filing. The FUTA is reported on the 940, but the other payroll taxes are generally reported on quarterly payroll tax returns, which is the Form 941 for most businesses. So it's considered a separate payment and a separate filing when a business pays the FUTA tax. FUTA tax is paid only by the employer, never by the employee. The current FUTA tax rate is 6% on the first $7,000 of each employee's wages, and it applies per employee. So if you hire 5 employees or 7 employees, you have to pay 6% on the first $7,000 of wages that you pay them. Most employers receive a maximum credit of up to 5.4% against this FUTA tax for any unemployment tax paid to the state. So states can have their own unemployment tax too. The tax is reported on Form 940, employer's annual federal unemployment tax return. The Form 940 is filed by itself, and it's filed annually to report the FUTA tax that the employer pays. Once an employee earns $7,000 in gross wages for the year, that is the maximum amount of wages that are subject to the FUTA, which means that the business no longer has to pay FUTA tax for that particular employee. It's per employee, on a per employee basis. However, if an employee quits and a new employee is hired, then the FUTA tax must be collected on the new employee's wages as well, up to the $7,000 limit. This is why employers really don't like employee turnover, because if you fire someone or if an employee quits and you hire someone new, then basically you have to pay FUTA tax on that new employee's wages up to the first $7,000 that you pay them. And here's an example. Pathway Brokers, Inc. hires a new receptionist on January 10th. The receptionist only works a month before quitting. She had earned $2,300 in wages in January before she quit. Pathway Brokers must pay $138 in FUTA tax on her wages. This is $2,300 times 6%, which is $138. If the company hires another employee to replace her, it will be required to pay FUTA tax on the new employee's wages as well, up to the $7,000 threshold.
The next webinar covers the trust fund recovery penalty. In this webinar, we cover the trust fund recovery penalty.
Let's talk about the trust fund recovery penalty, or the TFRP. Commonly, when accountants are talking about this penalty, they will just shorten it to the TFRP. This is the trust fund recovery penalty. It's also called the 100% penalty. This is when a business starts withholding income tax, Social Security, and Medicare from the employee's wages, but it doesn't remit those payments to the IRS. This is really bad. You do not want to be involved with a business that is doing this. If a business does not deposit its trust fund taxes in a timely manner, the IRS may assess a trust fund recovery penalty against the business owners, and against any accountant or any other responsible person that they can assess this tax against. The amount of the penalty is equal to the unpaid balance of the trust fund taxes. The TFRP may be assessed against any person who is responsible for collecting or paying withheld income and employment taxes, or for paying collected excise taxes and willfully fails to collect or pay them. Once that money gets taken out of the employee's paychecks, then it doesn't belong to the business anymore. The business has to remit those payments to the IRS because the employee is expecting to get that money back when they file their tax return, right? When they file their tax return, they're going to expect that withholding to be in their trust fund account. But sometimes businesses, when they start having cash flow difficulties, they won't remit these payments to the IRS. And then the IRS will go after the owners of the business in order to recover these amounts. Okay, it's basically like stealing, right? If you're stealing from the employees, if you're withholding these taxes, but you're not remitting them to the IRS. Once the IRS asserts the penalty, it can take collection action against the personal assets of anyone who is deemed a responsible person. It is not only the executives of the businesses or the top finance and accounting personnel who may be held responsible for the TFRP. A responsible person may also include a person who signs checks for the company or who would otherwise have authority to spend the business funds, such as a bookkeeper. And let me give you an example. Clora ran her own tax preparation business and also processed the payroll for her local church. The church had 4 employees. Clora prepared and signed the payroll tax returns and all the checks and gave them to the pastor to mail. The pastor did not mail the payroll tax reports to remit the payments to the IRS. And in fact, churches do get in trouble for this pretty often. They will have employees and they will be collecting the Social Security and Medicare tax, but not remitting those taxes to the IRS. The pastor used the money to purchase a new piano for the church instead of remitting these payroll taxes to the IRS. Clora knew that the pastor was misusing the funds, but did not report the information to the authorities. The IRS assessed the TFRP against the pastor, against the church, and also against Clora. The IRS will try to get these amounts from anyone they can. And if Clora had check signing authority, then they can go after her too. Even though Clora was just the bookkeeper, she knew that the pastor was improperly handling the payroll tax funds and she did nothing about it, so the IRS can assess 100% of the penalty against Clora. All right, so if you are involved with a business that is not remitting these payroll taxes to the IRS and you find out about it, that's a time when you want to fire that client as soon as possible because you do not want to be on the hook for this. And the IRS will go after anyone they can when it's a trust fund recovery penalty case. Remember this for the test. This is also called the 100% penalty. And the reason why it's called the 100% penalty is the IRS will try to assess 100% of the penalty against anyone they can. All right, that's the end. Next unit is going to be Unit 2, which covers accounting